Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, October 31st, 2023. Hope everybody's having a fantastical day out there. Happy Halloween. I'm not the dressing up kind anymore. Guess I could put on my old Navy uniform if I really wanted to go to a costume party or something, but it's kind of itchy to wear those dress blues if it's not a very cold place in the part of the country. So anyways, like I said, hope everybody's having a fantastical day out there. It is a beautiful day here in Colorado. Sun's out. The snow's still hanging around my front yard. Unfortunately, I went out and cleared a little bit more and have a little more space on the driveway to move around, but it's still slippery out there. So gonna need to buy a new bag of salt and all that good stuff because I'm running low on all the winter necessities. So, but my snowblower started up first thing the other day, so I was very, very happy about that. Anyways, all right. Well, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, press the like button, the subscribe button, the share button, the notification bell, because you want to know when I talk. Because if you miss out on something smart I say, it may be another week before I say something intelligent. So anyways, all right, let's go ahead and get into the numbers for today. Looks like markets were a little happier again today. The Dow Jones was up 0.38%, 123 points, closed at 33,052. S&P 500 was up 0.65, closed at 4193. NASDAQ up 0.48, closed at 12,851. The VIX was down 8.15% today. It's at 18.14 right now. Canada was flat, up 0.09. Brazil up 0.54. And Mexico down 0.32. In Europe, Germany was up 0.64. The UK flat, down 0.08. France was up 0.87. Netherlands up 0.59. Spain up 0.04. So it was pretty much flat for the day. Italy up 1.47. Switzerland up 0.09. And Portugal up 0.55. Russian exchanges both in the red today. The MOEX down 0.81. The RTSI down 1.32%. And the Asian markets look kind of mixed. The Nikkei in Japan was up 0.6%. Australia up 0.12. New Zealand up 0.24. In China, the Shanghai was down 0.09. The Shenzhen Component down 0.65. China A50 down 0.07. DJ Shanghai down 0.24. Hang Seng down 1.79. And the Taiwan weighted appears to be closed today. All right. So like I said, kind of mixed in the Asian markets, but for the most part, green. Nothing jumping too crazy to the upside, which I don't think is going to last very long. Personally, I think whatever steam and hopes people have coming out of this Fed meeting when they have their conference tomorrow, we'll see. I think probably they'll hold rates where they're at and then see where things are in December. But I wouldn't be shocked if they did a rate increase. The economy's still running fairly warm. Granted, it is slowing down and, things are not as good. It's kind of just a feeling. It reminds me a lot of 2007 where, the economy was losing steam. I was a brand new financial advisor at the time. I only had like a year under my belt and I didn't know what to look for at the time. I was taking a lot of the guidance from, my mentors and the people I worked around. But 15 years later, boy, it certainly does not look good right now. So, the yield curve and all the problems there and, the amount of inflation and the dollar printing. So, all right, well, let's get to the market recap for today. The Dow ends higher, but can't escape third monthly loss. Fed is eyed. All right, on the final day of October, the Dow Jones Industrial Average closed higher, but it marked the third consecutive month for stocks. The first time since March of 2020. The market was influenced by a mix of corporate earnings and economic data. Caterpillar, an industrial equipment manufacturer, disappointed investors as its order backlog narrowed, raising concerns about declining equipment demand despite beating Q3 earnings estimates. This led to a nearly 7% drop in Caterpillar's shares. JetBlue Airways also reported weaker than expected quarterly results and lowered its annual guidance due to, quote, challenging operational backdrop, end quote, causing its stock to fall by around 10%. In contrast, Wolfspeed Inc., a semiconductor company, saw a 22% rally in its shares after delivering better than feared quarterly results, which contributed to a broader rise in chip stocks. However, some caution was expressed on Wall Street, with analysts waiting for further insight into the performance of Wolfspeed's Mohawk Valley chip-making factory. Consumer confidence continued to decline for the third consecutive month in October, with inflation concerns being a major factor. Rising prices for groceries and gasoline were particularly concerning for consumers. The Federal Reserve's two-day meeting began with expectations that the central bank would keep interest rates unchanged. In the bond market, Treasury yields increased as investors looked ahead to the Treasury refunding announcement, following a recent surge in yields that has been partly attributed to an increase in the Treasury supply. The Treasury cut its quarterly borrowing estimate for Q4, which garnered attention from market participants. All right. So again, it's kind of mixed news out there today. All right. Some, I guess, good news. I don't know how we'll take this. It's about the UAW strike. Comes from Zero Hedge. It's titled UAW Strike Ends, but Spiking Labor Costs Will Hamper Detroit for Years to Come. Yeah, because you got to pay those people who just put together cards like Lincoln Logs, ridiculously high salary. It's like the post office. I went to the post office this afternoon. That's why I'm a little bit later today. Had to go run some errands, and one line with about 10 of us standing in, and I got my little survey here to fill out. So I'm going to make a complaint. And the guy at the front, when I first got there, they lost his mail and had business checks in it, and he can't pay his employees. So go and look up how much postal workers make. It is a ridiculously high salary for the substandard work that they do. I mean, half the time I have to deliver the mail that gets delivered to my box. I got to walk up and down the street and handle that. Anyways, all right, let's get to the article. Where were we? All right. The recent end of a 6-week strike by the UAW has brought some clarity. It will lead to increased vehicle prices for the foreseeable future. That's awesome. The strike concluded with General Motors reaching a provisional labor agreement with the UAW following similar deals with Ford and Stellantis. The labor costs resulting from these agreements are expected to affect automakers for years to come. Ford has already stated that the new deal will add $850 to $900 per vehicle in additional costs. UAW President Shawn Fain, while celebrating the strike's outcome, seemed to overlook the potential consequences for the industry if automakers face bankruptcy due to inflated labor costs. By the time the contract expires in 2028, most union workers at Detroit automakers are expected to earn in the mid-$80,000s annually, excluding overtime. The union successfully reinstated cost of living adjustments that had been relinquished in 2009. The UAW also secured the right to strike over plant closures, improved pay for temp workers, and a quicker path to maximum wages. Auto executives realized that in the current labor market amidst inflation and the UAW's strengthened bargaining power, they would need to be more generous in negotiations. Personally, if I ran these auto companies, I'd tell them to go kiss my ass. I'll hire an entire new fleet of people and probably do it for a lot cheaper. I mean, you got all these young folks who are looking for jobs. I mean, hell, how hard could it be to put a tire on a car? I used to build airplanes. I mean, come on. While the UAW achieved significant improvements, it also aims to expand its influence, including attempting to unionize non-union U.S. auto plants belonging to companies like Tesla, Toyota, and Volkswagen. Yeah, unions are just scum. I mean, they're basically leftists in the business world. They create a little government over your company, and all it does is make everything more expensive. Despite the significant wage increases, GM and Ford have faced challenges beyond labor costs, such as missing earnings and autonomous driving setbacks. Both companies have had to scale back their electric vehicle investment plans due to lower than expected market demand. Yeah, they're going to have to scrap those. Those electric cars are trash. The effects of increased labor costs have already impacted these companies' stocks and slowed EV adoption, which may not align with the pro-union stance of some. Ultimately, the consequences of this record contract, and that's in quotes, may lead to future challenges for the industry, potentially including layoffs. Yeah, wouldn't be shocked. I mean, what I would do if I was like a car, someone who works in the car industry, more local, I'd be snatching up vehicles that are 10 or 15 years old, rehabbing them, putting them brand new motors in, taking those because you don't have to do all the emissions crap because most of them are older than the cars that have to do that. And basically, you could build brand new cars from the older existing models that are just sitting around in used car lots and junkyards. So, anyways, that's what I would do. All right, next up, got an article here from Zero Hedge also. It's titled Peter Schiff, the U.S. isn't Japan, it's Argentina. Peter's always got very good views on things. All right, so Peter Schiff's perspective on the U.S. debt situation differs from those who compare it to Japan's. While Japan has a debt to GDP ratio of over 200%, the U.S. ratio is around 125. Probably can be a lot higher than that once the fiscal year numbers come out. However, Schiff argues that Japan is not fine, as it may seem. Japan is currently facing issues with its 10-year government bond yields rising to 8.7%. The yen weakened past 150 and increasing price inflation. The key difference between the U.S. and Japan, according to Schiff, is that Japan is a net creditor nation and its citizens save at a much higher rate than Americans. Japan holds significant U.S. dollar assets, including U.S. treasuries, mortgage-backed securities, which they are selling to mitigate the potential damage. Japan had more leeway in accumulating debt before reaching a crisis because it was wealthier and didn't need to borrow from abroad. This does not mean they won't face a crisis. In contrast, the U.S. is heavily indebted to the rest of the world and relies on foreigners buying U.S. debt to sustain its economy. If this reliance diminishes, the U.S. economy, built on the foundation of debt, will suffer. The comparison shifts from Japan to Argentina, a country in dire financial straits. The Argentinian central bank has recently raised its interest rate to 133%, still lower than the country's inflation rate, as inflation continues to rise. Schiff emphasizes that economic laws apply universally, and the U.S. is not immune to the consequences of excessive debt. Even though Argentina was once a wealthy nation, it is now facing financial turmoil. If the U.S. continues to accumulate debt and print money, it could end up in a similar predicament as Argentina. Schiff's view highlights the importance of addressing the U.S. debt situation to avoid potential economic repercussions. I agree basically everything he says there. It's a mess. And I mean, my view on it is no one's going to fix the problem. I mean, the idiots in Washington and at the Fed, they're just yes men and do whatever they're told. And, to me, it seems like, they're just looting the Treasury and stealing all the China as the Titanic is sinking. They're stealing all the gold and silver, utensils and the nice plates and everything before they head to the lifeboats. But, what I would try to do is, how do you take advantage of it? How do you take advantage of an economic system that is on the precipice of failure? I mean, there are ways to do it, and just making sure you're in the right spots. All right, last up, this article is titled "Investing Rules to Navigate Volatile Markets." Let's see what it has to say. In a year marked by surging interest rates, recession expectations, and geopolitical tensions, adhering to fundamental investment rules is crucial to maintaining focus and discipline in volatile markets. Rather than dwelling on worst-case scenarios, it's essential to consider the probabilities and possibilities of macroeconomic outcomes. This concept can be illustrated by viewing economic events through normal distribution curve. In this framework, 68.26% of the time represents normal outcomes, such as a typical recession or avoiding one. In 95.44% of instances, one deals with outcomes ranging from a deep recession to a standard economic growth. However, there's a mere 2.14% chance of experiencing a crisis like the 2008 financial crisis. If we come over here, you can see this. Actually, let me make that bigger so you can see it. This is basically the standard deviations out from the midpoint. And, usually when looking at an investment, you'll look at the standard deviation or the volatility and the standard deviation and how often it, sways one way or another. And if, let's say an investment has a mean of, say, we'll just use 10% as its mean, and it has a standard deviation of 20. And that means that from the mean of 10, it could go up as high as 30 or as down as low as negative 10. And that would be, within one standard deviation of the midpoint. And that occurs, like they said, 68.26% of the time. And then two standard deviations out, is 95% of the time. And then three standard deviations out is 99.72. So it's these things that happen way out on the periphery that are usually your either huge gains or huge losses. So that's why it's important to really have an understanding of the probabilities. All right. This concept, or do we already talk? Yeah, we already talked about that. Applying this idea to investment decisions resembles playing poker. Like a poker hand, investing entails weighing the possibilities and probabilities. The size of your investment should be determined by the potential loss if you're wrong. Here are 10 fundamental investment rules to navigate turbulent markets effectively. Number one, you're a saver, not an investor. Recognize that investing is speculative and involves risking your savings. Approach it with caution. Don't forget about income. Investments should generate income or appreciation. Diversify into asset classes like fixed income for lower portfolio volatility. Buying low requires selling high. Many investors excel at buying but falter when it comes to selling. Emotionally driven greed and fear often lead to poor decisions. Number four, patience and discipline prevail. Small investors stick to their strategies in both good and bad times. Don't go all in. Avoid excessive risk and manage your bets by balancing risk and reward. Number six, time is invaluable. The time lost due to market setbacks cannot be recovered. Factor time into your investment strategy. Beware of cyclical trends. Trends don't last indefinitely. Avoid extrapolating the current trend into infinity, as reversals are bound to occur. 8, success fosters overconfidence. Understanding that rising markets can mask investing mistakes. Sticking to your discipline during market ups and downs is crucial. 9, being a contrarian is tough, but often right. Contrarians who resist herd mentality can succeed. Trust your discipline, management, and intuition. And 10, avoid comparing to benchmarks. Stop benchmarking against market indexes. Focus on your goals, risk tolerance, and time horizon. Adopting these rules, coupled with an appreciation of uncertainty, risk management, and a focus on probabilities rather than possibilities, can enhance your investment success over time. Acknowledging uncertainty and being open to refining your decisions based on probabilities can lead to better investment outcomes. It's essential to recognize that while outcomes cannot be controlled, one can influence the probability of different results. And that's some very good advice. And that's something I've been telling folks for many, many years is, we look at the probabilities. Is the market probably in the next year going to go up, or is it probably going to go down? And, based upon those sorts of things, is it a, 90% probability or a 55% probability, or is it below 50%? And that means probability isn't real high, or, it isn't really likely. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. My email and contact and all the good stuff is there. You can book a meeting, read through all the stuff that I put on there. And that's basically it. So hope everyone has a wonderful evening, and I will talk to you guys next time. Adios.